Disney CEO Bob Iger announcing sweeping changes for the entertainment giant in his first earnings call since his return to the helm in November. 7,000 job cuts, billions in cost savings, and a new company structure delivering a dose of magic to investors. And this cost savings number, I really think surprised a lot of folks on the street. Some of the numbers that I heard coming into this earnings report, the street was looking for maybe cost cuts of around $2 billion, if not more. This is now more than double what many people expected here. So your first thought is a lot of costs, of course, coming out of this business. Profits will start to improve. And I can't say I am surprised to see Disney's ticker, our top ticker on the Yahoo Finance platform, after a cost-cutting initiative like this.
It's so interesting. You know, Nelson Peltz getting everything he wished for without actually having to have a board seat.
That's the life. You don't have to do any work. You just use your name and you boost the stock price.
Look, at the end of the day, when we were listening into this call, this was a kind of threading of the needle as we had described it yesterday evening after the call wrapped. But even going forward from here and some of the initiatives that they laid out, two things really jumped out at me that I wanted to point to. One of them is the efforts that they're going to have going forward. And within that kind of restructuring of the business, ESPN, the brand and program of ESPN, Bob Iger saying it's very healthy and they're not considering a spinoff of ESPN. That was one big answer that a lot of investors were looking for. What was the inclination of Bob Iger to really do with ESPN? Jimmy Pitaro is still going to be leading that division as it gets kind of its own pillar within the business. But then additionally, you heard about what the licensing strategy would be like going forward from here too, and that's on the table in some content licensing and being able to monetize that. You think about what ESPN or kind of Disney had done in the past. You used to see 30 for 30 on Netflix. You don't have that there anymore. Netflix has got Untold. It's not as good as 30 for 30.
It is pretty good, though.
But it's pretty good. But anyway, that's what we could see come back into the fray now with Iger, too.
One of the other interesting takes on ESPN came from Laura Martin over at Needham. She said maybe they won't sell the whole business. Maybe they'll sell a 10 to 15% stake in ESPN, which was sort of a different twist on what I had seen. As we look at this new Disney in these three different divisions, the remaking of the entertainment division is also something that a lot of analysts, including Martin, are focusing on here. She commented that it was Iger's most important operational change to give content creators P&L responsibility again. What does that mean? It means if you're producing content for that entertainment division, you are responsible for the budget, for making sure it makes money. When you're faced with a more than $1 billion loss in that business, it makes sense. And this is really fascinating to me, the switch in focus from subscriber gains at any cost to making that business make money.
Right, and when you stand up a reporting structure like this, to your point, Julie, it drives better accountability. Now, if these creative folks are not getting the job done, they don't come out with the right content, they're going to get axed. And that will drive more cost cutting at this business and then ultimately fuel what an activist investor like a Nelson Peltz wanted. It's not just to bring back a dividend, it's cost cutting, driving more efficient Disney, drive more creativity, improve profits, and finally get this really a business that is, in many respects, grown out of hands in some areas, get it under control, and just drive better returns.
We'll see if it works. In the meantime, that direct-to-consumer business at Disney lost $1.05 billion on an operating business basis in its latest quarter, with Disney Plus subscriptions falling for the first time ever, down about 1%. CEO Bob Iger also announcing it will no longer provide long-term subscriber guidance. The company won't. Let's dive into the streaming strategy with Yahoo Finance's Allie, Canal, who, of course, has been tracking this story very, very closely. So what are your takeaways here?
Well, even though those numbers seem pretty dire, that $1.1 billion loss is actually a significant improvement compared to what we saw in the fourth quarter. In the fourth quarter, Disney reported DTC losses of $1.5 billion. They guided that those losses would improve to $1.3 billion in Q1. So we saw this beat expectations in this quarter. So investors really championing that narrow loss under the leadership of Bob Iger, who did not hold back on those cost-cutting plans, as we were all just discussing. And on that Disney Plus subscriber front, that dip in subscribers was largely expected due to the loss of the Indian Premier Ticket League tournament. So that is something that was expected. And as you were saying, Julie, it really underscores this shift from subscribers to profitability. Even Bob Iger admitted that on the pricing front, there were some things that they probably got wrong. Too much spending on marketing, too much spending on promotion. So Disney is going to reduce that type of spending, along with its spending in general entertainment, going to be focusing more on what Disney makes Disney, which is really that family-friendly content. He also seemed more open to price hikes in the future, saying that the focus will be on quality subscribers, those subscribers that will remain on the Disney Plus platform, even if they price fees a little bit higher on those subscriptions.
Real quickly, I want to stay on this pricing, but we are getting a statement from Tryon and Nelson Peltz telling us via email, we are pleased that Disney is listening, Brad. So, of course, Peltz very engaged here.
Well, it comes back to the profitability that Disney had talked about on the call. By the end of 2024 here, pricing going to be a key strategy and part of that too. And that's from everything from the parks, the resorts experience, which they talked about, and trying to get that pricing right. But then additionally, on the ever-important streaming relationship that they have with consumers.
Right. Bob Iger seems really committed to have Disney Plus achieve profitability by the end of fiscal 2024. And on the park side of the business, that is something that Iger said that they probably priced too aggressively, that they were alienating a lot of consumers. He said the word accessibility. He said that over the past few years, Disney hasn't been an accessible park for a lot of consumers. And we've heard that across the board. A lot of Disney fans frustrated at those higher prices. And Bob Iger last month, he did make some of those adjustments, providing a little more freebies to those premium park members. So we should continue to see some changes on that front as well.
All right. Yahoo Finance's own Allie Canal helping us break down all things ticker symbol DIS Disney. Thanks so much. Appreciate it.